Good afternoon, everyone, and thank you for joining us today. The session today is focused on subcontracted R&D, externally provided workers, and overseas costs under the merged RDEC scheme, an area that has posed many questions as firms absorb the new rules and then look to apply them in practice. As mentioned in the promotion about this session, in our last webinar poll, these cost categories raise the most uncertainty for our audience of accountants and advisors. So our goal today is to run through the key changes, the importance of smart information gathering to ensure that you're fully prepared for all the details the additional information form will be looking for, and also a brief look at how WhisperClaims supports our users in making confident decisions specifically related to our topic today during the claim preparation process. For those of you who maybe are newer to us, we are WhisperClaims. We are software and support designed specifically for accountants and advisors preparing R&D tax claims for their clients. We don't prepare claims ourselves. Our role is to help firms deliver this work in-house with efficiency, structure and consistency. And that's it for me just for the moment. I'm going to hand over to Jen to take us into the detail.
Cool, thanks, Suze. So yeah, as Suze said, we will be covering overseas rules and a little bit on subcontractors, and then have a wee bit of a chat about what is needed to actually fill out the additional information form once you've decided which of your EPWs and subcontractors can be included in a claim. So first of all, we are going to talk about the overseas cost restriction, which I know has caused a lot of confusion. There's a lot of, I would never say that the HMRC's rules are subjective, but they're maybe not the clearest around this, and especially in terms of the exemption. So we'll talk about this kind of slowly and carefully just to make sure everyone can understand what what you need to be thinking about when you're preparing claims for your clients. So the headline rule, the headline thing you need to remember is that overseas EPWs and contracted R&D are not allowable costs in the new RDEC and ERIS claims. So as a general rule, if your client has used EPWs based overseas or has contracted out some part of their R&D to companies based overseas, you won't be able to claim it. Now, this doesn't affect any other cost categories. So, for example, staff costs for overseas employees, as long as they're on the payroll, that is absolutely fine. You don't need to worry about them. If raw materials have been bought in from overseas, so if you're ordering chemicals from France to do experiments, absolutely fine again, even though that might be paid in euros and paid to a French company, that would be absolutely fine, no issues there. Software bought from overseas, obviously, most cloud computing packages that anyone buy, you're paying either the States or another country outside of the UK. And again, that is absolutely fine. And I've got et cetera, any other costs that are paid to overseas companies come from overseas, absolutely fine. It's only EPWs and contracted out R&D or subcontractors that are not allowable. Quick note here about Northern Irish companies. The rules are different for companies in Northern Ireland. So if a company has a registered address in Northern Ireland and they meet the ERIS criteria, so they're loss-making and they meet the R&D intensity threshold of 30%, they would be claiming through Northern Irish ERIS, which has specific provisions. So these companies are exempt from the overseas restrictions. So they can claim for any subcontractors, any EPWs at all, but those claims are then subject to restrictions in de minimis aid. So they're restricted in a different way, but they're not affected by the overseas restrictions. Now, there's not a huge number of companies that will go into this category, but it's very important you're aware of the difference between the rules for Northern Irish companies claiming through ERIS and all other companies claiming through RDEC or ERIS. And just to be clear, for Northern Irish companies, if they're claiming through RDEC, they are subject to the restriction. So it's only under ERIS and only for Northern Irish companies that would have that exemption. So if you're thinking about specifically EPWs, and just to be clear, EPWs, that's externally provided workers. So that's where the company has a tripartite agreement where they contract with an agency to provide staff to them, and the agency pays the staff and the staff work for the claimant company. So just to be clear, that's what we mean by an EPW. The key points here is payments subject to UK PYE can be included. So if you've got any EPWs that aren't subject to UK PYE, then they are subject to the overseas cost restrictions. The location of the EPW is totally irrelevant. So as long as they're subject to UK PAYE, they could be based in Ukraine, they can be based in the Netherlands, they could be based anywhere else in the world, as long as they're paying UK PAYE. What you can see quite often is if you are using workers overseas, they might have some of their salary subject to UK PAYE and the rest not. So you can only look at those payments that are subject to UK PAYE. Yeah, so that's that. Sorry, I shouldn't glance up the questions while I'm talking. So yeah, essentially, you just need to be looking at the PAYE status of those EPWs. That's the only thing that really matters. And if we contrast that with contracted R&D, so if you're claiming for subcontractors, it's kind of flipped on its head compared to EPW. So only payments made for work carried out within the UK can be included. And again, for complete clarity, that is Scotland, Ireland, Northern Ireland, England, and Wales. So not overseas territories, just the kind of core part of the UK. So that work has to be carried out physically in the UK. Everything else is irrelevant. So if the subcontractor normally lives in Germany and comes to the UK to do the work, absolutely fine. If the payment is sent to the US, because the company is based in the USA and carries out their business there, absolutely fine. Currency of the payment doesn't matter. So you can be paying for the work in yen. That would make no difference. The key thing is the work has to be carried out within the UK. So you can see also the flip side is you might have a UK subcontractor who has gone to live in Spain for 3 months. So even if you're paying them through UK company, through in pounds, because the work isn't physically being done in the UK, it cannot be included. It is subject to the overseas cost restrictions. So you can see it's a very different conversation you need to have with your clients around, okay, for your EPWs, let's look at payroll, let's look at whether they were paying UK PAYE, whereas for subcontractors, it's got to be where physically was your subcontractor when doing that work. And that might mean a conversation with the subcontractors themselves to make sure they were within the UK when that work was being carried out. Now, the other key thing to understand is that there is a very open exemption to the overseas restriction. So what HMRC need to see, there's 3 points they need to be satisfied about to grant an exemption to the overseas cost restrictions. And we have been seeing people now coming through saying HMRC hasn't questioned it. They've been quite happy with the exemption reasons I'm given. So HMRC seem to be being quite pragmatic about this. We'll see how it goes as more and more merge scheme claims are going through and being processed by HMRC. But to claim an exemption to the overseas restriction, you've got to first show that the conditions required for the R&D are not present in the UK. So this could be legislative, geographical, social. So if the first example HMRC gave is if you're studying volcanoes and there's no live volcanoes in the UK, you need to go overseas, which people were like, that's helpful, but also not hugely applicable. If, for example, in a more applicable way, there's this very specific kind of testing that the company needs to do to know whether their R&D has worked, and those test facilities do not exist in the UK, that would be absolutely fine. If they're trying to get FDA approval and the FDA says that some trials have to be carried out in the US, and that's the only way to get legislative approval for a new drug, for example, then again, that's fine because you can't, that's a legislative condition that doesn't exist in the UK. So you need to be thinking about whether the conditions required for the R&D are present in the UK. You've got to obviously be able to show that the conditions required for the R&D are present in the country where the R&D was carried out. There's no point saying, oh, we had to do tests in the US to get FDA approval, so we used a French company and they did the work in France. That doesn't make any sense. You know, that doesn't line up with the conditions you said that were needed for the R&D. So those two things need to come together. And you've also got to be able to demonstrate it'd be wholly unreasonable to recreate the required conditions in the UK. Now, again, the rules are quite open about what wholly unreasonable means in this situation. Basically, they're saying it could be cost, ability, timing. So if the company could theoretically build their own testing facility, but that would delay their R&D by 3 years, obviously HMRC aren't going to say, well, it would be reasonable for you to recreate that. It's fair to say it's wholly unreasonable. It's a massive cost and something they would never use again. This also could cover things like the company doesn't have the in-house expertise to do this work themselves. They can't suddenly create this ability where they are. And timing matters. So one of the examples they give is obviously if there's one testing facility in the UK, but that's booked up for a whole year and you can't get in there to do your tests, using an overseas thing would be seen as reasonable. So as I say, I'm going to get onto the two hard and fast rules, but there's very few hard and fast rules in terms of exemptions. You just need to be able to demonstrate these 3 points about anything that your client has done. The 2 things that you cannot choose an exemption is the cost of the R&D activity and the availability of workers to undertake the R&D. These can be parts of the reason. So the company might say, well, there's no workers in the UK and these conditions don't exist. That's absolutely fine. But if the only reason that the company has outsourced their R&D to somewhere overseas is because it's cheaper to do it over there, or there's more workers. So these 2 exemptions seem to be very pointedly directed at software companies outsourcing their software development, because the government knows that there's a shortage of software developers in the UK and they know it's cheaper to do it overseas, but they do not want to see this work being outsourced purely for those 2 reasons. So again, you need to have this kind of in-depth conversation with your clients about exactly why did you outsource this. If it's just cost, if it's just availability of workers, or even both of those together, you wouldn't be able to claim an exemption. So there's quite a lot of information needing to be gathered. Conversations need to be had about this to make sure that you are claiming the costs correctly and you're not putting anything that isn't eligible. Cool. So that's overseas. I was saying to the guys this morning, it's one of these things that is actually quite straightforward when you look at the rules, but will be quite complex when you're applying it to your clients. So much as that seemed quite a quick summary, there's going to be a huge amount of conversations and complexity that you might come up against with your clients. And we're obviously really happy to answer any questions about that. But moving on to the rules around contracted out R&D. So as anyone that's been doing R&D for any length of time knows, under the old RDEC and SME schemes, the decision about who could claim for subcontracted R&D was actually a bit difficult, especially as the rules were different for companies claiming under RDEC who couldn't claim for the subcontractors and SMEs that could claim for their subcontractors. And then if you had someone that was working as a subcontractor, it depended on who they were working for as to whether they could claim for that work or not. So there was a huge amount of complexity in there. Happily, under the new merged schemes, so both new RDEC and ERIS, this has been clarified, simplified, made a little bit easier to apply. So key thing to take away from this is the rules are the same for everybody. So no matter the size of the company, the scheme they're claiming through, the rules about who can claim for subcontracted R&D and what costs you can claim are exactly the same. And as I say, the rules have been actually clarified about who can claim for any contracted R&D project, just to make sure that there's no double dipping. Now that anyone can claim for their subcontractors, it means that subcontractors themselves, you need to be looking at who owns that project in a much more detail than you maybe did before. So the 2 main factors that HMRC have highlighted as things to look at when you're looking at who owns that R&D and who can claim for it is who initiated the R&D and who was aware of the need for the R&D to be undertaken. So which of the companies within that contract, who started it and who knew it needed to be done. So this means when you're looking at it about who can claim for any particular project. So a company can claim for work contracted out by them if they enter into a contract for activities to be done for them. So obviously there has to be a contract. They're going to carry out R&D activities. The activities done to fulfill the contract include R&D, and the company contracting out that work knows that the R&D needs to be done. And it is reasonable to assume that they intended R&D of the sort to be carried out when they entered into the contract. This is something that it's going to be interesting over the next year or so as again more and more merged scheme claims are processed to see exactly how this is actually applied. HMRC have stated, it's not there, it might be in the rules. I'm going to say it's possibly not in the rules, but it's something they definitely stated, is that you couldn't have a blanket clause. You can't have companies going out subcontracting any and all work. The blanket clause says if R&D needs to be done, then it's ours. So there needs to be an in-depth knowledge, a kind of intention understanding within the company setting the contract that this R&D needs to be done, that it will meet the criteria for eligible R&D. It's not simply if you do any R&D, it's ours. It has to be specific, it has to be understood, and it has to be at the point where the contract is set. So as I say, it can't just be a flippant, well, we can do it. It can't be something that you can, in hindsight, go, oh, we knew you'd have to do R&D about that. There needs to be something at the points where the work is contracted out, that they knew and understood the R&D that needs to be done. On the flip side of that, companies can claim for R&D done to fulfill a contract if they took the initiative to undertake the R&D. Now, under the old rules, we would have called this emergent R&D. So you've maybe taken on a contract to do something, to produce a widget, to produce some software, whatever it is, and realize that it can't be done and you need to do a little bit of R&D to work out how to get there. So HMRC have kind of clarified this and set this in the rules that the company, if they took the initiative to undertake the R&D without the direction, without them not even necessarily having the knowledge, so without the company that's contracted out the work to them even having the knowledge that's been done, that suggests it's theirs. And again, the company contracting out the work did not intend for or necessarily even know about the R&D that needed to be done to fulfill the contract. And obviously the work has to meet HMRC's criteria for eligible R&D. So it can't be where they're doing one specific part of an R&D project that in and of itself isn't R&D, but feeds into someone else's R&D. Obviously, you need to be able to look at the project in isolation and say, yes, that definitely meets HMRC's criteria. So as you can see, it is clearer how this again is applied as time goes on, as different contracts are put in, as companies maybe try to navigate these rules between them about who's going to get to claim the R&D. It's going to be an interesting process, but for now, this is how HMRC have set it out, and there's some really good examples of this kind of thing in the guidance that you should probably go and read because it really sets out nice and clearly for everyone. Okay, so we understand our overseas rules and we understand how to decide who's claiming for subcontracted work. So now we're just going to have a quick chat about information required for the AIF. Because as these new rules have come in, as these new criteria have come in, there's actually a lot more information needed for the additional information form than you needed before for EPWs and subcontractors. So for EPWs, you need to know, obviously, the total EPW costs included in the claim, as you would have done before. So that's how much was spent on them and how much was actually R&D. But you also need to state of that figure. So if there's £100,000 spent on EPWs, how much in a monetary value was for work undertaken overseas. Undertaken overseas. So you need to look at, okay, 40% of the EPW costs actually came from overseas. So I'm going to do that split and say that £40,000 worth of that £100,000 was for overseas. You need to know the number of EPWs included in the claim. And then you need PAYE references. Now, it doesn't ask specifically. So if you've got a list of 20 to 30 EPWs, all from the same agency, so therefore all having the same PAYE reference, you don't need to provide the same PAYE reference multiple times for each different EPW, but you do need to have all of the PAYE references for any and all different places where the EPWs came from. And then if you are claiming for EPWs that weren't subject to UK PAYE, you need to know the reasons for exemption to the overseas restrictions, and that's just a free text box in the AIF where you can describe exactly why you believe those costs are exempt from this restriction. So there's quite a lot more in there. The PAYE references, if you can't provide them, I would say don't claim for those EPWs. You need to be able to give HMRC all the information they're asking for and not kind of try and wing it and see whether HMRC notice. I think it's really important that you're able to provide all the information that's asked for it. If you can't, you'd have to exclude those costs. For subcontractors, again, there's a huge amount more detail needed. So as always, total subcontractor costs included in the claim. So again, the cost of each individual subcontractor and how much of that was actually R&D. And again, you need to show how much of that was for work undertaken overseas. So you need to be able to show that of that, however much you're claiming for subcontractors, this chunk was undertaken overseas. You need your reasons for exemption to overseas restrictions. So HMRC will simply say what the questions ask, was any of this undertaken overseas? And if it was, why are you claiming it? But again, because what we talked about previously about deciding who could claim for subcontracted R&D, for each company subcontractor, so each subcontractor that could potentially claim R&D tax relief themselves, you also need to provide the name, the company number, the country of registration, and what costs were claimed for those individual subcontractors. So you do need a full breakdown of the subcontractors, their costs, and then you need to know their company number and the country of registration. So there's a little bit more again for subcontractors, purely so that HMRC can obviously be looking at, okay, this company is on someone else's R&D claim for this much, and then they're claiming themselves. Let's look at those two together. So it's just helping HMRC look at any double dipping that's going on and making sure it's all legitimate costs. So I think from here, I'm going to quickly jump into the WhisperClaims app just to show you what that information gathering would actually look like. So within the app here, we have the EPW question. So you can see here, this company has used 2 EPWs for their R&D claim. This is the total cost of that EPW. We're looking at whether they're connected or unconnected. Now, this isn't something that HMRC asks for, but when you're calculating the costs, you need to know whether they're unconnected or connected to know whether you're using the 65% filter. We're looking at the location of that EPW, so whether they're in the UK or overseas, and then you're looking at the PAYE reference. So for every EPW included in the claim, you need all of those pieces of information. And what I'm going to do is just take out this PAYE reference to show that if you say the EPW is based overseas and doesn't have a PAYE reference, what you're going to have to do is provide those reasons why the costs were exempt from the restrictions. So within WhisperClaims, obviously we can allow you to say they weren't exempt from the restrictions and that the software itself will exclude those costs, or you need to be able to give HMRC some kind of insight into why you believe those costs should be included. So again, just to go back to that question, for every EPW, you need their name, the total cost, whether they're connected or unconnected, where they are in the world, and if you have one, a PAYE reference. For EPWs based in the UK, you do have to have a PAYE reference. Obviously, if they're overseas and aren't paying PAYE, but you're claiming an exemption, you won't have that information. But for UK ones, you absolutely have to be able to give that. I'm just going to skip forward now to the subcontractors question within the app, just again to demonstrate the information you need. So here you need even more information than you did before. So you need the name and subcontractor name, which is fine. You need the costs. Again, you still need to know whether they're connected or unconnected, because that will affect whether you're applying the 65% filter or not. You need to know whether they're a limited company or not. If they're not a limited company, then they're not going to be subject to needing the registered company, the registered number, and that kind of thing. So that gets you away from some of that. If they're a company, you need the registered country and the registered number. If they're a UK one, you don't have to give it for an overseas company. It's not a required thing. It's not going to prevent you filling out the AIF or anything like that. But if you've got it, it's useful to have. And then you need to be able to say where the work was carried out. Was it carried out in the UK or overseas? And again, if I flip this now to say that was an overseas subcontractor, and I jump forward again, so separately to the EPW's reason, you need to give a reason why the subcontractor costs were exempt from the overseas restrictions. So it's possibly the same reasons, it's possibly different reasons, but you just need to make sure that you're explaining those 3 points to HMRC every single time you do this to make sure that they understand why you're claiming that exemption. There's not, the way the AIF does it, as I say, at the moment, it's just a text box. So there's not you can't tick a list to give your reasons. There's not drop downs, all that kind of thing. They're giving you a kind of open box to explain why you've included those costs. So just to reiterate what I covered there, for subcontractors, you need their name, total cost being claimed for, the type of the subcontractor, whether they're connected or unconnected. You need to know whether they're a limited company, because HMRC will ask for whether they're a company or not. You need the registered company, registered number if you can get it, and then where the work was carried out. So again, making sure you have this up front, making sure you don't find yourself filling out the AIF, missing pieces of this information is really, really important, because you cannot proceed with filling out an AIF without this, and you do not want to be caught on the back foot and having to kind of phone your client and say, I'm halfway through your AIF and I don't know the registered number of 3 of your subcontractors. So we need to be gathering this up front and being able to do things kind of proactively rather than reactively. So I think that's actually all of the technical information we're going to cover today. So I'm going to hand over to Suze for just to talk a wee bit about our trial process, and then we'll get back to some questions.
Thanks, Jen. That was great. Yeah, just to give you, Jen, a couple of minutes to catch your breath and get a drink, and also to allow you all to please get going with the questions. I can see we've got a couple in the Q&A box already, so please feel free to send over any that you'd like us to answer live. Of course, if you don't want to add questions in the live chat today, feel free to drop us a message. I'm just actually going to pop my contact details in the chat just now, and just tell you a bit about our software and a trial and a demo if you like one. As you can see, WhisperClaims handles all these scenarios. So if you'd like to see how that works for you in a live claim environment, you're very welcome to book a demo or a trial, or even just a chat. We invite you to explore our software and advice line during a 30-day free trial, which includes your first claim download for free, and we also offer an optional review if that's something that you'd like us to do. This gives you a really straightforward way to see how WhisperClaims supports a more efficient, structured and compliant in-house claims preparation service. There's no obligation post-trial, so feel free to get in touch. As I said, my details are in the chat, so you can get in touch using any one of those methods. Yeah, back to you, Jen. That's my doorbell ringing, so I'm just going to put my...
Cool. Thanks, Suze. Yeah, we've got a couple of questions. So while Suze is waiting for doorbell to stop ringing, I will read out the first one, which is what info is needed if the subcontractor is an individual? So from what I showed you there, let me just jump back in because it's the easiest way to explain this. If they're an individual, if I say no to that, so they're not a limited company, you actually only need their name, the cost, whether they're connected or unconnected, and the fact they're a limited company means it takes away from a lot of what you need. You do also need to know whether they're based overseas. So the restrictions apply regardless of the type of entity being subcontracted to. So you need to know their name, their cost, whether they're connected or unconnected, and where the work was carried out as a key thing. Basically, within the AIF, it will ask whether any of the subcontractors were companies. If you say yes to that, then it will ask for that breakdown of name, costs, everything like that. So you're only asked for the bigger breakdown if they are companies themselves. Hopefully that makes sense.
Thanks, Jen. Sorry about that. We've got a couple of questions from Michael. First one, how can we have an overseas employee who is resident in an EU country and does not have a UK NINO?
I'm going to assume that's national insurance number, but I don't actually know. To be honest, this is not my area of expertise. So the only thing I can say is purely that if someone is employed and is on the books as an employee, they are not an EPW and therefore are not affected by the overseas restrictions. How that is, I feel like I should know this because we did have an overseas employee for a while at WhisperClaims. So it's something I don't want to jump into too much because I don't have any expertise in that area. So from my point of view, the point I'm trying to make is purely that regardless of the setup, if they're an employee of the company, then it doesn't matter about the overseas cost restrictions. If they are not directly employed by the company, so again, through an agency, through some kind of tripartite agreement, then they are affected by those restrictions. Sorry, I could be any more helpful there.
Michael also asks, what is defined as being connected or unconnected?
So this is defined in the rules by HMRC. So there's a whole section on what makes a company connected or unconnected. So it's to do with ownership, it's to do with just relationships between with the directors and their family, all of that kind of things. The whole list of reasons why two companies might be connected. The most obvious, obviously, is that they're owned by the same people or they hold shares in each other that go beyond 50%. They're within the same group. But it also can be a situation. So myself and my husband both own companies. Our companies are connected because we were married. If my brother was to start a company, we'd be connected. So there's a whole host of reasons why a company would be connected. And you've got to look at the ownership of that company and how if it is linked in any way to the ownership of the subcontractor or the company that is paying those EPWs and providing them to the claimant company. So yeah, it's probably, I can't go into it in a huge amount of any more detail here, but yeah, there's a whole host of reasons why they'd be connected, and it's it's laid out very clearly in the CIRD, so I'd recommend having a look at that.
Thanks, Jen. Okay, next question. If a company has an employee that was on their UK payroll but has gone to live abroad and they are not treating them as a subcontractor, can they still claim for them if they're overseas? If it would be unreasonable to find someone to do their job if they have a deep understanding of the business?
So again, this is a little bit dependent. So I'm reading from that they're no longer on the payroll. If they're not a subcontractor and they are an employee, then that's absolutely fine. It doesn't matter. If the company, you could have overseas payroll within the company. Again, I'm not an expert in employment law, but just going with the guidance that is given about this within the CIRD, there's nothing to stop you having overseas employees and claiming for those costs. If they've gone overseas and they are treating them as a subcontractor, so they're no longer an employee of the company, but they want to continue working, they've got a deep understanding of the business. So there are some examples within CIRD around availability of expertise. So they give examples of needing to work with research groups in a particular university who have expertise that's only found within that university. Then of course you'd need to use those overseas subcontractors. So you could have that argument here that it is not possible to access their expertise within the UK, that expertise is key to the project and doesn't exist anywhere else but within that person's head. You could try that as an argument. And as I say, there are examples of that kind of thing where you're looking at, as say, research groups, particular areas of expertise, particular people, companies, whatever it is that aren't based in the UK, where there's no equivalent within the UK of that level of knowledge. It being specific information about the business is not something that's covered within the guidance directly, but it's probably worth making that argument that there isn't anyone else with that knowledge and you have to use that specific person.
Thanks, Jen. Another question from Michael here. We have asked HMRC for advance clearance for overseas costs. Are we likely to get a response?
I mean, that's a difficult one to answer. I know that some people have been trying to get this from HMRC. I haven't heard of anyone that's been successful in getting HMRC to kind of rubber stamp overseas costs. I know from experience in different parts of the scheme, HMRC's response is generally, we'll put in the claim and we'll tell you if we don't like it. It's definitely worth doing. I think they are, from what I can tell of the way that we've been interacting with them as well as other companies been interacted, they do seem more open to that kind of conversation now. I don't know, other than obviously the advanced assurance scheme, there's not currently advanced clearance really available in any official capacity. So you might get an inspector saying, yeah, that seems absolutely fine. And then the inspector that actually looks at the game has a different opinion. So I think it's definitely worth having the conversation. I'm not sure how much of a response you'll get and whether it will be worth the email it comes in on if it's a different inspector with a different view on things when it actually comes to being assessed after being submitted.
Great, thanks, Jen. Whoever's sent this next question, thank you. I was just about to question whether you had the right dates there, and you've corrected there, so that's great. So the question is, what are the exact date issues? The start date for the new rules for accounting periods starting on or after the 1st of April 2024. So would you confirm the old rules still apply for all EPW subcontractor costs incurred in all 12 months of the accounting period starting on 1st of Jan 2025 and ending on 31st of December 2025? Sorry,
okay. Yeah, so again, the dates have been corrected. So this is talking about if you had a claim period starting before the 1st of April 2024. So if it started 1st January 24 and ran to 31st December. So yeah, you're absolutely right. The whole claim would be claimed under the old rules. So the whole 12-month period, you're applying the old rules. There's no overseas restrictions, anything like that. The new merge scheme only applies to accounting period starting on or after the 1st of April 2024. It's not an exception to this exactly, but if you've got an extended accounting period of account that's made up of 2 accounting periods, if the second of those accounting periods starts after the 1st of April 2024, then you'd be looking at, say, the first 12 months of that extended accounting period being done under the old rules and the last 3 to 6 months, say, being prepared under the merge scheme rules. So that's the only time you might have to look at one period of account but 2 accounting periods claimed under different rules. But as I say, the new merge scheme rules apply to accounting periods starting on or after the 1st of April 2024. If it starts before that, then the whole period goes under the old rules for everything, including subcontractors, EPWs, and overseas costs.
Brilliant, thank you. That's why there's quite a lot of confusion just now, isn't it, Jen? Because there's so many claim paths available to use, which
by our calculation, there's 9 different ways you could prepare a claim right now. So in terms of there being 6 different schemes currently active, and then because some of those can combine with other ones, you're looking at 9 different ways that you might end up preparing a claim, depending on all the different factors around dates and times and grants and subcontracting, and all of those things can push things down different routes. So it is an interesting time to be working in R&D tax relief, definitely. Roll on 2 years' time when most of the old scheme claims will have timed out and we won't have to think about it. But still a little while to go.
Still a while to go indeed. Well, looks like there's no more questions just now. If anybody still does have a question, please do. I'll waffle on for a couple of minutes just to give you an opportunity to write any more if you have them. And if anybody didn't feel comfortable sending in any questions to be answered in the live environment, you've got my contact details in the chat there, so please do feel free to drop us a message. Just in case anyone had to leave or was distracted by phone calls and things like that as we were going through, we will be sending out a recording of today's session, and it will be up on our YouTube channel within the next couple of days as well, so there'll be plenty of opportunity to watch back on demand if you so wish. Yeah, we really appreciate you being here. As we said, WhisperClaims handles all of these types of scenarios within the app, and also all the different claim paths that you may possibly be exposed to just now. So if anybody does want to get in touch for a chat or a trial or just a more in-depth demo, please do let us know. Our next session for next month, for March, we're going to be looking at pre-notification. This is a subject that we've covered before, but it's also an area that has caused a huge amount of confusion within the sector, and one that sort of continues to do so. So no harm in revisiting those key points again, so that everyone is prepared for the March year ends that will be upon us in no time. It's bookmarked for the 11th of March at 12 noon, and we'll be promoting that more widely in the next couple of weeks. So do look out for an invite. No more questions have appeared, so we'll give you the rest of your Wednesday lunchtime back. Thank you so much again for joining us, and we look forward to speaking to you all again in the near future. Thanks a lot. Take care. Thanks, Jen.